you're going to see it win week after week until it doesn't.
Carl Allen trades options like an engineer, mechanical, data-driven, and consistent. His rolling put credit spread strategy stacks small wins, manages losses, and compounds over time. Today, he will show you how he does it. Welcome, Carl.
Thank you. It's great to be back with you.
Give us the 40-second version of why rolling put credit spread is your favorite strategy.
Well, I like it mainly because I see it as a fairly low stress trade for me. It allows me to make easy decisions. So it combines two common option trading techniques. So I sell put credit spreads, and then I manage it by continuously rolling them every week. Key attributes are that it's a defined risk strategy. It has a high probability of profit. It has mechanical discipline. I just follow my rules and keep with it. And it's a relatively high risk and high reward trade. And so for all those reasons, I really like it and trade it almost all the time.
And it's been going well for you, hasn't it?
Yeah, I've been doing this for years.
Carl, you are back for the third time. We have done two interviews with you before, one about the back ratio call spread and one about 21 DTE broken wing butterfly. So I do recommend people to watch those if they like the interview today. And then you also run a website called datadrivenoptions.com. Tell us a little bit about yourself.
Well, like you mentioned, I am an engineer, and so I enjoy math and statistics. And so that's one of the reasons options really has appealed to me. I'm based in Kansas City, Missouri in the US. And like you said, I run the datadrivenoptions.com website. I've been doing that for several years, and I enjoy the interactions I get from different people who come to the site and read about things. I started the site mainly to share things that I'd learned over time in options that I couldn't find, like in books and things that as I was discovering, different things about options, the statistics behind options, different trading techniques, different trading strategies, things that kind of go behind the scenes of options that I thought were interesting. Based on feedback from people that have come to my site, I think other people have enjoyed it as well.
And you have written a very comprehensive article about the strategy we will discuss today. So we will share the link in the description. It is really recommended to read it if you are curious to learn more about this strategy.
Yeah, I've actually written probably, I think I've counted 5 different versions over the years about different kind of variations and things. And so I rewrote it just to kind of summarize how I look at it kind of more holistically, knowing that we were going to be talking about this today.
So the strategy is called rolling put credit spread. But let's start with the very basic. What is a credit spread?
Very good. So, some people call it's a credit spread, or some people call it a bull put spread. The idea is that we sell a put at a strike price out of the money that's higher than a different put that we buy at a lower strike price. So we're selling a put to try to make money off of its decay, and the put we're buying is there to protect us on the downside. So if the price were to go down and go through the puts, the lower put would be a protection from us having undefined losses. So because of that, it's a defined risk trade. The trade is such that we're going to collect a credit based on the difference between what we sell the higher put for versus what we have to pay to buy the lower put. And so we get a credit. And because we've sold more than we've bought on the puts, it's bullish. We do best if the market goes up. We can make money if the market stays the same. We can make more money if the market goes up. And if the market goes down, we're probably going to lose money. So that's kind of the way the trade sets up. It's a spread because we have 2 options, one that we've bought and one that we've sold. So the reason I like spreads is that it's a more efficient use of capital. If you were to sell a naked option, you're going to use a lot more capital, either to do a fully covered put Or if you're selling a put on margin, usually you're going to have to take 20% of the price of the stock as buying power reduction. With a spread, you're only at risk of the width of the spread. And so that really reduces the amount of capital you use. And because you're using less capital, you have a potential for a lot higher rate of return than selling single options by themselves.
Carl, keep covering the basics. Rolling is the core part of this strategy. What does it mean that we roll?
So rolling is when you close an option position and open another option position, usually further out in time, all in the same trade. So in this trade, I've got two positions, the option I sold and the option I bought. And so the way I like to do this is a week after I've been in the trade, I'll put in an order to close those two option contracts and open two new option contracts. So selling a new option and buying a new option to replace the ones that I'm closing. And I do that all in one transaction. So it's a 4-leg trade that I'm putting in. And my goal in each of those rolls is to collect a net credit. So I end up with a credit each time I do one of these rolling transactions.
Okay, very good. So it's time to get into the specifics of how you trade this rolling put credit spread. Let's start with your underlying. Which underlying are you using and why?
So I like to use index-based underlying. So that can be index ETFs like SPY, QQQ, or IWM. So that basically the three main indexes, the S&P 500, the NASDAQ 100, and the Russell 2000. So you have the ETFs that represent those. So you also have index options, so SPX, NDQ, and RUT. Those are much, much bigger products. So typically they're 10 times as much as, well, in fact, the NDQ is huge. It's 40 times as much as the QQQ. And then there's also index futures options that you can use, typically like ES, or the /ES or the /MES, but all index-based securities as opposed to individual stocks. And the reason is individual stocks have a lot more propensity to have outsized moves, particularly outsized moves to the downside. And when that happens, it can be bad. And a lot of times if they have big outside moves, they don't recover anytime soon. So most of our indexes, when they have a big move down, typically can wait them out and they'll eventually come back around. It's just a matter of how long you have to wait for them to come back around because, they're a broad basket, diversified, either 500, 100, or 2,000 stocks, making up those indexes. So that's why I like to trade the index options on index-based products.
So index, either the index itself or the ETF that is mirroring this index. So you are ready to open your first put credit spread. Please give us the specifics, DTE, etc.
Sure. So let's start with delta. So for those that aren't familiar, delta is a measure of the probability of, what's the likelihood that that option will expire in the money. And so I like to trade sell a 20 delta put and buy a 13 delta put. And those might seem like very specific numbers. And it's just that I've done a number of analysis over the years. The main one is that if you look at every combination of options you can sell and buy and as a spread, and you chart it out into a big matrix and you compare the premium you get and the decay, the theta value of those, and then divide that amount of decay, which would be your decay income by the amount of capital that you risk, 20 and 13 turn out to be, in pretty much every analysis I've ever done, the best combination to give you the most return based on decay, of any of the other combinations you can have. So whether it's wider, narrower, higher delta, lower delta, that seems to be the right combination.
And 20 delta on the short basically means that there is a 20% chance of the short being in the money at expiration.
That's right. And then the 13 means that there's a 13% of the long being in the money at expiration. Typically, I like to trade 4 to 6 weeks out. I like to roll after a week in the trade. I try not to have expiration ever come into play, but it's still something in the background that you have to keep into consideration. I trade 4 to 6 weeks out because I like to be far enough out that I'm not impacted that much day to day by big moves in the market. So if the market goes up or down, a percent or two in a day, it really doesn't matter that much to me. I'm waiting for a week's worth of moves to decide what I'm going to do. It works out well. I have a full-time job outside of trading, and I really don't have the time to be spending watching every move of the market. And so, I can look at the market at the end of the day. Oh, the market was up this or the market was down that. It's like, okay, fine. And then in a week when I'm ready to adjust with a roll, then I'll figure out what I need to do based on what's happened. But because I've started 4 to 5 weeks out and I've only let a week go by, the market generally isn't going to move that much compared to where my strikes are. So, I don't see huge implications from the market moves most of the time. That works out really well for me to be that far out in time. And then when I roll, I just keep rolling back out to that same amount of time over and over again. So I stay well away from expiration all the time.
Would you like to collect income from options every week with defined risk? That's exactly what 3 traders are going to show us in the next Theta Live on November 5th. We are bringing together 3 options traders who each have built consistent income systems, all powered by Theta. First up, Simon Black, creator of the Time Flies strategy, a smart twist on butterflies and diagonals.
So my goal for the year is 100% return.
Then it is Steve Gans with his Fliagonal strategy, seeing a very high win rate.
If we go up and volatility drops, the butterfly's making money for me. If the market goes down and volatility increases, the diagonal's making money for me.
And Ravish Ahuja with his double calendar strategy.
If I were to just trade double calendar in an account, I can make well over 100% annually.
3 unique ways to turn time decay into consistent income. And you can ask them all your questions. Don't miss this Theta Live. It's going to be filled with actionable ideas. Check out the link on the screen and register now. See you on November 5th.
So we will get into the rolling and how you do that. But let's bring up an example first. We have set up an example here in option strat of trade on SPY that was set up on this day of recording.
Yes.
What do we see here?
So we have the market at 665. We are going to then sell the 632 put, and we're going to buy the 614 put. So that gives us an 18-point wide spread.
And this is 30 days out in our example. 37 days out, excuse me.
Yeah, so you're right in that range. And so, a lot of times I think about it as kind of in the middle is 5 weeks, but you can pick any. The nice thing is with this, you pick, if we're doing this on a Wednesday, then maybe I'll roll every Wednesday, or maybe I'd set it up every Thursday, or every Monday, every Friday, whatever. I can just pick a day of the week and then a week later make my adjustments. But even that doesn't have to be exact. So, being this far out, there's plenty of flexibility in how I deal with it, just stay to the same general routine.
And Carl, this one shows how this trade will look at expirations in 37 days. We have a max profit of 184. We have a max loss of $1,616 in this.
So so think about that. 184 is just over 10% of the width. So we have an 18-point wide spread. And so that's $1,800 kind of at risk, minus that 184 that we collected. But that 184 is basically 10% of the width of the spread. And so what we're hoping is that we're going to be able to, if the price doesn't move, we should get about 10% of that in a week. And if the market goes up, we're going to make more. If the market goes down, we're going to lose. I think that's where we're at. But you can also see on this chart.
If I move it back, this is situation today at the starting point, right?
Right.
And now it's $2 in unrealized loss on this example. But let's move it out to 1 week. In this case here, now we see that we have around $16 in profit. And then trade eventually end up like this.
Right. And so if you look at that at 7 days, if the market has not done anything, we're going to be able to have a profit of about 1/10 of the premium we collected to start with. And if the market were to go up, you can see that the curve goes up pretty quickly. We can even have the market go down just a little bit and still break even. And then obviously if the market goes down, we're going to lose money. If you look at that probability curve, you can see basically where we would expect the price to land. It's going to land pretty close to where we're starting out at on the scale of this big graph. We don't expect it to move a whole lot away from where we are today. So, if you think about it, you would expect most weeks, 1, 2, 2.5% at most in either direction.
So our example trade. Now it's time to really dig into your rolling. We know what the rolling is, but your mechanics for this and what you do in different situations. So please dig into the details of your rolling routine.
So my strategy and the mechanics I use are that each week, after I've been in the trade for a week, I'm going to roll from the expiration that I'm now at to a week further out in time. So back to the same amount of time that I started with. So if I'm starting at 5 weeks out, once we get down to 4 weeks, I'll roll back out to 5 weeks. So I'm trying to get back to where I started. And my goal is to try to always roll for a credit. So that means if the market has gone up, I'm going to roll my strikes up to, again, try to hit my same delta values of 20 to sell a 20 put strike and buy a 13 put strike when I close out whatever my values are today. And if the market has gone down, I'll roll down, but I'll only roll down as far as I can and still collect a credit. So usually I can roll down maybe a strike or two, regardless of what's happened, and still collect a credit. It just kind of depends on how far the market has gone down. And so that's on most weeks, I'm either rolling up or rolling down and still collecting a credit. And that works probably 95% of the time. The market's up over half the time. So that's really easy because I'm rolling up and I'm collecting usually a pretty good sized credit in that situation. If the market's gone down, I'm trying to collect whatever I can. Basically, what that means is I'm going to have a little bit higher deltas on my new trade than I had with my original trade. And I'm basically waiting for the market to eventually recover and get back to where we were when we started. And then I'll get anything that I've lost, I'll get that all back in the future. That's the general strategy that works, the vast majority of the time.
So always roll for a credit.
Always roll.
And then, of course, the obvious question is, what happens when you no longer can roll for a credit?
So when we started this, our strikes were quite a ways out of the money. We have quite a bit of room for the market to go down before we start getting into trouble. But once our strikes are in the money, if the market goes down enough that our strikes end up in the money, then we do have a problem, because now with a spread, we go from having decay working for us, which is where we are when we start, to decay working against us. Because now when our strikes were out of the money, as time goes by, we're moving towards having our strikes all be worth zero. When the strikes are in the money, they're both working towards a situation where both strikes are in the money and to expire at a value that is in the money. The difference at that point, if we were to hold all the way till expiration, would be the width of the width. So if we had that 18-point wide width, we would expire with the spread worth $18 or $1,800, and that would be a total loss for us if we held that all the way to expiration. So that's where things are headed. What we have is a choice, so a week goes by, and if we're in the money, either because we had one really big move or we've had a series of slow moves over time, we kind of have a choice of what we're going to do. And so I look at it as kind of three choices of how to manage that. So the first one is I'll roll out my existing strikes to the same strike a week out in time. And if I do that, I'm not going to collect a credit. I have to pay a little bit of a debit to keep those same strikes, because that's just the way the math works out. They're just more expensive because of the time values involved. Basically, that is a choice. If I'm just saying, I just want to buy time, things don't look that bad, I'm going to just see if the market will turn around and get me back out of the money and get back to decaying again. The second option would be to say, well, we've moved a lot and I don't want to keep losing money from decay working against me. So I'm going to roll my strikes down to a point where they're out of the money again. So if the current trading price is below the strike price of my options, I'm going to have to roll my option strike prices down to get them below the current price. And I'm going to have to pay to do that. And I might have to pay quite a bit, so I might be paying 10, 20, 30% of the width to get down back to where I'm out of the money. And the reason I want to be out of the money in that situation is at least now I'm back to where I have decay working on my side. So that's a choice. The third choice could be, and I typically don't do it, but I can see how some people would just be to close the whole thing out and say, okay, I'm just going to wait and start over at some point in the future. The one thing I don't like about doing that is if I close when I'm way down, I don't have any chance of getting any benefit from when the market comes back. And so part of the reason I like to use one of the first two options is I want to get as much of a gain as I can when the market comes back. So that's why I tend to, doing this as a mechanical roll, even when the market is down, keep rolling with the idea that when the market comes back, I'll gain all the premium that I'm sitting at. If I'm sitting at deltas that are, say, like 50, 60, or 70, that means I'm probably at about 60, 70% of the spread width and premium, and I can gain all that back if the market, comes back. And usually our biggest up moves in the market happen after big down moves. The market never has huge up moves when it's sitting at all-time highs.
But Carl, you say if. But how long will you keep doing this if you have to pay each round of rolling and market keeps going down?
That's
Will you ever stop, or will you just take on additional risk again and again?
I personally have just kept on taking on additional risk. There have been some times where that's been very, very unnerving. This means that this is a very risky trade, and you have to have, if you're going to stay rolling, even in the worst of times, you have to have additional capital available to put into the trade. You can have some pretty big drawdowns in bad times with the goal of, I want to recover most of that back when the market comes back. But for me to recover that, I have to be in the trade when the market comes back. And so that can be a very unnerving thing. So you can see a drawdown of well over 100% of what you had to start with, in that trade. And so you've got to have a lot of capital. You can't put your whole account on something like this because at some point, you're going to get tested and you're going to get tested hard. You got to have the risk tolerance to be able to handle that. And I know that that's not the case for a lot of people.
I always ask my guests, what is the worst that can happen with the strategy? And I guess this is it.
Yeah. Yeah. So, and probably the worst would be a situation where we have an extended bear market. If I look at this decade, we've had 3 pretty significant downturns in the market. We had the COVID crash, but that really only lasted like a month and a half. That was a big test. And I was trading this trade during that time. And boy, when we were at the depths, it was like, man, was this going to come back? Every day it was a real struggle, but it eventually did. And within a month after they hit the bottom, I was already back to better than where I started. The worst one, though, was the 2022 extended bear market. The bear market lasted for 6 months, and we were down well over 20%. It just was a drip, drip, drip. It was just down a little bit, and it just kept going down and down and down and down and down. And it lasted a long time. So it was a matter of continually paying those debits. That added up more and was a tougher situation than the COVID situation because it extended out for as long as it did. And then we had in April of this year, we had the tariff scare, for lack of a better explanation of it, where the market dropped. I think it was down 19% at the worst, maybe even touched 20% down. But that only lasted a few weeks, and then it rocketed back up. So if you would have cashed out towards the bottom, you really would have missed that big upswing that the market was up over 10% in one day coming out of that. The biggest one-day increase in the market, I think, in history was off of that bottom.
But
So,
Carl,
yeah.
there is also another question I always ask, and that is to put your strategy on a risk profile scale from 1 being very low risk and 10 being very high risk. And you pointed out to me that 90% of the interview guests tend to put the risk of their strategy between 4 and 6. So are you going to break out of that?
I'm going to break that trend today. I'm going to say this is an 8 or a 9. There are riskier trades in this, but this one's up there because of just what we just talked about. You can lose a lot of money because we're trading that 4 to 5 weeks out, 4 to 6 weeks out in time. It's a slow motion crash of the position. If you're in the wrong spot, you're going to have a pretty big loss on your account for whatever you have tied up in this trade. I'm not going to sugarcoat this because when we're down at a low and you're continuing to roll, you're counting on the market to turn around. And most of the time, even in the worst situations, it turns around, but there's no guarantee that it's going to turn around, and you don't know when that's going to happen. And so you've got to make a decision. If you're getting into this, how long are you going to be willing to stay with it? And, is this even a trade that you're comfortable with? And I have a feeling for a lot of traders, this level of 8, as I think of it, 8 or 9 is too much. For people that want to do this, and as long as they're keeping a small part of their portfolio, this can be a very rewarding trade as well. So typically with high risk comes high reward.
Carl, you've been trading this for years. And I'm curious, how many times have you actually realized a loss? How big losses have you taken on this?
In 2022, I did take off several positions, and those that were down probably 80% at the time. And it was a deal, 80% being what I started with, plus then I'd added stuff to try to keep it close to at the money. And when I finally decided that I didn't see there was no end in sight, and I decided to pull the plug, I'd probably, say if I had put 10,000 to start with on it, I was down 8,000 when I pulled the plug. That's really the only situation where I really stopped trading it.
You pointed out yourself, many traders may not be comfortable with this kind of risk, and I can honestly say myself included. So are there ways to adjust this strategy that may reduce the risk for those of us who are not so happy with the high risk?
Yeah, there are. So some things you can do. One, you can play with all these different little rules here. You can go with a little longer duration. More duration means you can have your strikes further away from the money. So you've reduced what percentage of the time you're going to get the strikes end up in the money. You have more time to react. You have more time for the market to balance out. That's one way. You can go with lower deltas. You'll have less decay income to take more of a move to get your strikes in the money. The other thing is just kind of how you think about rolling. My rule of I always want to collect a credit, maybe there's there's other ways you can do that. You can also just roll back to every time roll to a 2013 delta if that's where you're starting. And what that does is sometimes you get a credit, sometimes you pay a debit, but you're always staying in that kind of sweet spot. And you'll pay it. If the market's going down week after week after week, you're going to pay a debit week after week after week, but you're not going to have your strikes get real deep in the money typically in a 1 week period. And as the market goes down, the implied volatility is going up. And so each time you're doing this, each time you're going to get strikes that are further and further away from the current price if you do that roll, even though you're paying for that. So that's one way to do it. That way you're not accumulating this huge loss that at some point you pull the plug on. You're evening yourself out every week. So it's almost like starting over each week if you do it that way. What that doesn't do though is if we've had a big fall and you roll down, if the market goes back up, you're not going to make as much money on the upswing as you would if you had tried to keep rolling for credit. There's a trade-off for everything. The key thing is understanding how this trade works and then understanding what your trade-offs are. And then as you look at each element of the trade and you want to make adjustments to it, just understand what you're trading off. There's a benefit to that trade-off and there's a detriment to that trade-off. And as long as you feel better about the benefit than the detriment, then
So is it time to get to the benefit or the meat on the bone? What have been your results trading this strategy, Carl, over those years? How do you measure your results?
So I typically like to look at it as kind of that initial amount of capital I risk. So in our example we looked at, that would be $1,800, the width of the spread. The decay from that tends to be about 1%. So I've collected 10%. And after a week, on average, the decay itself is worth about 1% of that 10%. I go from 10% to 9%. So, overall, that's 1% of the width of the spread that I should be able to make just on decay every week. Average that out, that's almost 50, that's over 50%, or give or take about 50% per year. And then I also get a gain from the positive drift of the market. So the market is going up over time. And so on average, the return tends to be whatever the market goes up, the up or down, actually. If you go back and you look at the deltas and how much leverage you've got in this trade, you get about 3 times as much movement based on price movement of the underlying, for the spread. And so think about our typical market is going, say, anywhere from 8 to 15% on average in a year. I'm going to see then 3 times that. So somewhere in the 20 to 40% gain just based on price adjustments. So then I should end up somewhere in the 70 to 90% of that initial amount.
You say you should end up like that, but
Well,
is that
it's going to vary. It depends on what the market does. If the market goes up more, I'll make more. If the market goes up less, I make less, and I could, obviously I can end up with a loss.
But what have you actually ended up with each year in the last 2 years?
Over time, that's where I'm averaging. But then you also have to remember that I can't just look at that amount of money because I have to keep another chunk of cash on hand to deal with those drawdowns when the market goes down. So, this can only be a fairly small portion of my portfolio that I can let ride up and down over time while I have that cash or cash equivalents that I can draw on when I need to, if on those occasions when the market puts my strikes in the money. My goal hopefully is I've got some chunk of cash that's earning some return, drawing 4 or 5% interest, waiting for the time when I actually need to go pull it out and put it into this trade. So you kind of have to factor that in. It's not like I can get an 80% return on my portfolio in a year. I can get an 80% return on that little chunk. And that's one chunk of, other things I'm doing in my portfolio.
So let's sum up 2 questions. Who is this strategy best suited for? And what would be your 2 or 3 most important takeaways for those who would like to try something like this?
So I think it's for somebody who wants to put a portion of their portfolio into a high risk, high return, but also a high probability trade with a high, the potential for high return. And also somebody who doesn't have that much time. I'm okay with a high level of risk on a small portion of my portfolio, with the idea that over time I'm going to do really well with that portion, knowing though that there's going to be times that I'm really going to be tested. I'm really going to lose a substantial portion of it, with the hope that I'm going to gain it back when the market comes back. So hopefully if there's people that type of a trade appeals to, that's who I think this is good for. If I had to sum this up, again, we haven't really talked that much, but because we're starting with something that only has a 20% chance of being in the money at expiration, and we're adjusting it every week, we've made this into a pretty high probability trade. And so it wins a lot more than it loses. One challenge is you can get lulled into complacency because it wins. You're going to see it win week after week until it doesn't. So you can't get complacent and go, oh, well, this is working great. Let me scale up and put, all my portfolio in it. You do that, you're going to lose it. That's the downside of high probability. High probability means you win most of the time, but when you lose a lot. So you have to be prepared. So it's high probability, but it's high risk with the potential for high return. And it's a very mechanical trade strategy. I like it because every week I know what to do. I just look at where am I at? What are the strikes a week further out that I can roll to that get me as close to back to my 2013 deltas, or that I can roll down to and still collect a credit. And that's my decision I make. I put in the trade, enter it, wait to get it filled, and I'm done. A few minutes worth of effort a week. And so I like that part of it.
My question, Carl, because you have pointed out a few times this is something you do with a small portion of your portfolio, and you trade many different strategies. How much of your trading portfolio are you allocating to this strategy or similar high-risk strategies?
So I probably have about 10% on this trade, and I have a few other what I would consider pretty high-risk strategies that I probably have another 10%. And then I'm probably 50% in more like stocks, maybe stocks with covered calls and things like that are more risk tolerant, types of trades, and probably about 30% cash or cash equivalents. So that's kind of how I've structured my personal portfolio.
What would be good resources to learn more about this?
Like I said, I've written about this several times on my website, and I've written an updated version that should cover pretty well what we've talked about today in even more detail than what we've discussed. One of the influences that helped me was Tasty Trade. They really helped me understand a lot of things about trading, and particularly durations, trading a little longer duration than maybe I would have at earlier times. The Tasty way is like 45 days and get out at 21 days. And so this is somewhat of a variation of that, but it's also kind of within that same window. Check out my website. It has this trade in a lot of detail and several versions that I've written about it, and plus lots of other trades, and then lots of other information about option basics.
And I will also really recommend people to go to your website, datadrivenoptions.com. You have written a very comprehensive article about this strategy that is very good to study. And one good thing is that you don't try to sell anything. You're just sharing your knowledge with everyone. Not trying selling a course, not selling any mentoring.
Yeah, that's right. What I've found over time, and I think you probably can agree with this, is by me writing these things, I probably learn more by writing this stuff than maybe I ever help anybody, because writing this stuff down makes me really think about it. You really have to understand what you're writing. And so I get a lot of satisfaction out of learning as I write about stuff. A lot of times I'll realize when I'm writing something that maybe I missed something, and it forces me to rethink my strategy. And, as I research and put together the charts and the other things, and I really try to make sure all my probabilities and things match up, it really helps me to understand what it is I'm doing and makes me a much better trader. And I think you've seen that in the people you've interviewed, that because you're doing that, you've said that you've become a better trader as a result of it.
That's very much my motivation for doing these interviews as well. I learned so much from it that helps me become a better trader. Carl, thank you very much for sharing this rolling put credit spread strategy. And I do recommend to watch also the 2 other interviews we have done with Carl if you liked this one. Thank you very much, Carl.
Well, it's been my pleasure. Thank you.